I'm Scott Bennett with Mike Olafson of Invest with Rules. This is Trends with Friends on March 27th, another fun Friday where there's a lot more uncertainty in the market. We're going to cover the market. We're going to cover a lot of trends, and we'd like to keep you on the right side of the trend as best as possible. We have a couple topics about where we're at with a macroeconomic backdrop, which is slowing growth, rising inflation. The price of oil and energy continues to climb, which is pulling the market back even further today. Before we jump in, this is just information, not a direct solicitation to go buy or sell anything. Please always manage your risk, follow your rules. This is a tough market out there. We care about you. We want you to do extraordinarily well, but that does mean at times clicking buttons to manage risk. Again, if you have questions, we'll answer them here. Hello at Invest with Rules. Thank you for being a part of our membership. We greatly appreciate you. We also run a completely separate business called IWR Advisors. If you're like, this is totally amazing, but I'd rather someone else click the buttons and help with financial planning questions while I go live my best life, that's hello at iwradvisors.com. We follow trends, we follow big money, and we follow an awful lot of risk management rules. And let's talk about that, Mike. We have a very busy slide called the weekly market wrap. Let's wrap it and talk through it.
Okay, excellent. First thing, wanted to point out that we added a new asset class. So the top of the page talks about the asset classes, how they're doing. We are over on the far right-hand side, and we'll talk about our performance. And then down the bottom, we'll talk about the action we've taken during the course of the week. But to start off in the asset classes, we did add the US dollar. We thought it'd be interesting to add that as another major asset class. And we're using the ETF UUP that represents essentially the bullish dollar, and it's tracking, I believe, the US dollar index. Scott, any thoughts to why we add the US dollar or anything you wanted to add before I continue on?
Yeah, I just think it's an interesting perspective to see how currencies are moving, which do move other asset classes. So the dollar has a direct impact on equity prices, on the precious metals prices. And it's hard because not a lot of people actually trade currencies, but it's a reflection of how strong the US dollar is compared to other currencies, whether it be the euro, the yen, or additional currencies. And as there's more fear in the market, there's likely a press up of the US dollar valuation, which is something to take note of. So we just wanted to add it there as perspective as you look across all the major asset classes.
Yeah, thank you, Scott. And so then to bring it back to the left, we start with the US market. We'll talk about the S&P 500 and big tech stocks represented by the Qs. Another pretty nasty week so far. And so the week down, month down, year to date, the Qs are now in correction territory, meaning 10% drawdown from, I believe, January. Actually, if you go back, we'll take a look at the Qs in a little bit, actually chart of it. But I think the high the Qs reached, as I recall, was back in October, and the Qs are now down over 10% from that October high. And interestingly enough, the Qs now are an official break on our trend roadmap. So that hasn't happened for quite a long time. So I think that's definitely something for us to take a look at with the charts later on, Scott. Then, as you continue on for the week, the winners really are the global equities, actually kind of are shaping up to have a pretty decent week. Commodities are about flat as represented by PDBC, and that's a basket of commodities such as oil and copper, gold, all kinds of things. Gold is actually having a surprisingly good week and good day today. Bonds are flat. US dollar, we talked about, that's up a little bit for the week. Bitcoin's having another nasty week. Month is okay. And we, with our trend roadmap, are up about 0.7% for the week so far. Then if you look at the winners for the month, it's obviously commodities. PDBC's got a big chunk of oil, no surprise there. And Bitcoin, yeah, it's interesting. It's actually having a decent month. Year to date, we talked about how the U.S. equities are doing. And if you come over, commodities doing really well year to date. Gold is still up 5% year to date. And we are a little bit over 9% year to date. And then just recapping the signals, we talked about the NASDAQ 100 now being on a break. The only other break is Bitcoin, and it's been on a break for quite a while. And then Wrapping it up with our strategy trend roadmap, we are right now, as of this morning's actions, we are 45% invested, and our portfolio heat is about 4.7%. Portfolio heat is if all of our stops got hit, that's our estimate of how much our portfolio would be down. And at this point, 4.7% is our estimate. Then talking about, just to recap this week's actions, a lot of actions this week. We closed a lot of positions, including RWM, which was our small cap hedge. Small caps are actually holding up surprisingly well. And obviously, with the last couple of days' action, we wish we hadn't closed that out, but we have to manage our risk. So every step of the way we're managing risk, and RWM a couple of days ago was actually the small caps were doing well. RWM was getting hit, so we managed risk, took it out. Then if you go to open positions, the open positions, we added definitely some tech names such as Marvell and Applied Materials, which ended up being closed out today. Ross Stores, a discount retailer, and OIH and Oil Services ETF. And Cortiva, which is an ag play that's been doing very well of late. That was another open position. Lastly, before I flip it back to you, Scott, to fill in any blanks, is we did increase slightly our position of XTL, which is the telecom ETF. And basically, we've done XTL, we built that up to a full position in three different trades because of lack of cash availability when we added them. So this week with XTL going to a gas, we added the last small position in XTL to bring it up to a 5% standard position. As you'll recall, our model is 20 positions, 5% each, or I should say max 20 positions, 5% each, and XTL now is at that 5% level. Scott, sorry, threw a lot out there. Anything you clarify or any blanks you'd fill in?
Yeah, I'll play so we live and breathe this stuff. Two guys who are obsessed, two fun dorks looking at trends. But I would say ag is agriculture. PDBC is primarily more of oils and precious metals. We did add to the ETF rank this week PDBA. We added that ticker Veggie, which are companies that are supporting the agricultural space. You'll see that in the ETF rank, and if it shows up on the watch list, we may go after it. We added the dollars Mike shared. The only thing I would definitely focus on is portfolio heat. Whenever you own hedges like SH or PSQ, we do share like what would be the risk to the stop, but if the stock market bounces, which we'll talk about, or it falls further, those will offset. So it's not, that's why we call it an estimate of risk because it's likely they're very non-correlated. So they will likely not move to the stops at the same pace or of any capacity because they move in opposite directions. Okay. A lot of action this week again. We've continually rotated, and we'll talk more about that. But the stock market score as a 2 is pretty telling that global stocks, US and international, are under severe pressure, almost to the point where you have some capitulation. And let's talk and look at that as well. So, this happened this week. So, inflation. The Organization for Economic Cooperation and Development, they do these forecasts twice a year. These are just forecasts, but it's interesting. They see the US inflation is actually at 4.2% this year, way higher than the Fed is estimating. And that's why you've seen the Fed very unlikely to be lowering rates. Maybe it's more likely raising, actually, but not unlikely to lower rates this year at all. Then later in the article, they do give some perspective in regards to growth. And they see growth accelerating at a pace of 2% this year before easing to 1.7%. So falling in 2027. They provide these updates twice a year. These are just estimates. A lot of people have estimates. But I'll share with you, this is from a third-party research firm, Hedgeye. Ray Dalio has famously talked about the quads, but we are firmly likely in this quad, which is an economic stance of slowing growth, rising inflation, which some people will call stagflation. And then we'll look at how that tends to play out. At the moment, we're not in this. If inflation was slowing and growth was slowing, that's where you get your horrible deflationary 2008, 2022 type environments. We're not there at the moment. And that's why you've seen the equity markets down 5 to 6%. They're off almost, the NASDAQ is now off 10% from peaks, but you're not seeing massive capitulation at this moment. Now, this is from the third-party firm Hedgeye. I find their information interesting. The question is how actionable. So, really interesting. So, over dozens of quad threes of stagflation, they share what are the best asset classes, what are the worst asset classes, what are the best equity sectors, what are the best and worst bond sectors. And let's just simply apply it to our trend roadmap, is how I like to think about it. And these are always subject to change. And how we're seeing it right now is even though they say throughout this quad three environment, you typically have a situation where gold, commodities, and bonds tend to do really well, and then credit, meaning like more corporate, lower risk bonds, tend to do worse. So far, commodities are the only things holding up on gas. Gold on coast, bonds on coast, credit on coast. I think this is interesting. Best equity sectors during a quad three environment historically are utilities, tech, oh boy, energy, industrials, consumer discretionary. It's just energy so far. You're seeing tech could easily slip into a break, like consumer discretionary. And then worst sectors, which is not proving the case, is telecom is doing really well. We do own XTL. There's an S&P version of it as well that tends to own more like Verizon and AT&Ts, but those are holding up well. Financials and REITs are getting hit pretty hard. And then a mixed bag, and you're seeing the short end of the curve, of the bond curve, start to tick higher. And that's where tips tend to do well if there's inflation, where everything else is like the Vanguard Value Index is on coast. And most of these things are on coast, and small caps on coast, and munis are on coast. So lots of coast. That's a lot to throw out at you. Before I move to the next section, I just want to cover some thoughts on trend. Mike, any comments on quads or questions that are of things to talk about?
Yeah, question came up in the chat from Jason. What are tips?
Treasury inflation protected securities. They are a subsect of government bonds that have an inflation kicker, where if inflation goes higher, the bond has the ability to actually go higher. The most popular ETF is TIP.
Yep, great. Thank you, Jason. Yeah, great question. And so, to your point, Scott, is especially if you could flip to the next slide, if you could, the one you did there. Yeah. Is any of this truly actionable? What are your thoughts? You mentioned that, hey, it's suspect as far as actionable types of, yeah. So I guess the bottom line question is, Scott, is this useful to us or any investor in terms of taking action?
I think it's interesting. Helpful is a great term. From looking at, I studied lots of different newsletters over my career, and every system goes deeper than you could imagine. So even though historically these tend to do well or these tend to do poorly, they have different ways to say not right now, or they have different ways to go deeper in more shorter term. And that's where we rely on our trend roadmap. It's primarily based on price and momentum and strength, and it gets us to a very less confusing outcome. It's just green or yellow or red or blue, and it's all codified. So I would say interesting, not surprising, but there's always some gems to pull out of it. And I think our human mind wants to find a narrative always. That's who we are. That's how we're built. We're built to survive. We're built to find narratives. We love stories. And sometimes the story's really important, and sometimes it's not. And sometimes it's just click buttons and play defense. But if you're looking for the narrative of the why are things going the way they're going, is you have rising inflation, you have slowing growth, and a lot of this is not terribly shocking or surprising. If I go back 25 years ago when I first started, like if I think about my early days of learning about the markets, and you learn about modern portfolio theory, which is own stocks, bonds, and cash and just sit there and ride it. I think that's a totally fine mechanism if one's in their 20s or 30s. But if one is built a net worth and is heading towards retirement or in retirement, the Magnificent Seven aren't looking so magnificent right now. So this is the narrative of why they're looking so miserable. I'm going to just share a couple of things. So at the bottom is the trend roadmap chart on the S&P 500, and these slides are in the members area under the market update section. But we've come a long way since last year's tariff, and then we had the U-turn, and then we had a very nice gas signal that lasted quite a while, all the way until October. And then the shakeouts happened at the end of last year. And then we've been forming this topping pattern for a really long time. We've been playing an awful lot of defense. So there's a million kind of ways to describe cycles, whether it's the accumulation phase or the participation phase or the excess phase. I would dare to say that doesn't feel excess to me. But if you pull the chart way back to 2008, yeah, I could see that. And let's just talk about maybe we are in what we'll call the distribution phase right now, where it's just this very first section of the pullback. And at some point, we know it gets some version of a bounce. So far, the market is not reacting well to this escalation in Iran continuing and the Strait of Hormuz being more or less stopped and clogged. But then what happens, and are you prepared mentally if you do get some version of a bounce and then you get the participation phase of everyone selling harder? And then what if we are nowhere near the panic phase? So I'll come through. We shared these monthly charts on March 12th, then not too long ago on VT, and we were looking at could this be some issues coming up for the total market? And I think back then the stock market score was pretty decently mixed. It was, I don't know, 6, 7, and now we're at a 2. And then on 312, we showed kind of where could this market pull back to if we do get a normalized correction. And back then we weren't even at the absolute top, but we said, what if you came down to some version of a parallel support area? We said, could you get your garden variety 11% pullback? Because when you get -5, you tend to get the average about 11. And here's the chart today I snapped, and you're about halfway there. And if I think I snapped it from over here, so maybe not exactly halfway, but what if right now you get a further pullback or you get some version of a bounce into another pullback? This is where this chart tends to rely. But then I want to share how can you figure that out using the tools in which we give you? And then how do you figure out what phase you're in, which I think is nearly impossible, but the trend roadmap will be your friend, and I want to share with you how. So let's exit this if it will let me. And let's move over to a trend roadmap chart. And let's move over to IVV. And can you see everything, Mike?
Yep.
Lovely. So I'm going to go to a daily chart and zoom it out. So I don't know, is this the excess phase or kind of what phase is this if you depends where you start from. But if we look and we zoom in again, green is gas, yellow is coast. We don't have any breaks on the S&P 500 yet. The green line is just a 21-day exponential moving average. A lot of people like to look at it. The red line is the 50-day simple, and the black line is the 200-day simple moving average. And you have a really another nasty Friday again, unfortunately. You've undercut this support area from November. You've undercut this area that we just had back in March. So what you'll likely see when you start getting capitulation is, let's get rid of that, are these fun green arrows. So these are what we would call our confirmation signals. It's a inter, like an even smaller fractal signal to us that maybe the pain might be over. So you had your tariff low on April 7th, and then on April 11th you got one, the 14th you got one, the 15th you got one, and then it faded, and then you got a whole series, and that was officially your higher low, and off you went. So the things that would to us is we are not seeing those yet. So because we're not seeing those yet, could things potentially get shaken out a little further? That's possible. If you take its opposite friend, the SH, it's now on an overheat, an orange box, which is a RSI, a relative strength index over 68, and you have the confirmation signals still. So that's why we still own the inverse of the S&P 500 in the model. So is the distribution phase over? Likely not yet, unfortunately. Is the bounce started? Likely not yet. But just when everyone gives up, that's when the little bounce or big bounce starts and it starts moving. Okay, Mike, I want to share that. What other questions or comments are pulling up on anything that you're looking at?
We've got some suggested tickers to look at, and I'd say we do that when we finish our recap. But for now, yeah, go to the hub and let's take a look at our holdings, the live sheet. Yeah, in fact, definitely start at market health, and then let's go to the live sheet, and then let's go back to charts,
Yeah.
please.
So the stock market scores a 2, and our exposure is quite low on global stocks. Where our exposure is quite high is the energy sector. And you're seeing utilities come back, which we tried. We had a utilities position. We had to manage risk. You're seeing small caps show strength. You're seeing materials show some strength. We added Corteva. So you have two sectors on gas. The rest are under pressure. We are 45% invested, and of which a lot of that are energy and materials. So it's really just stuff to the right. Our beta is half of the market, and our heat we talked about already. Mike, what would you add on the market health?
I think you covered it. I think it's super interesting and telling. Really, this to me, the reason I love the market health tab is it really sums up what's going on. And that, especially the sector strength gauge, it just really sums it up nicely. And then if you want to dig a little bit deeper into the S&P 500, that kind of sums it up too. Looking at Microsoft and Meta on the left, Meta is definitely getting kicked hard this week. And then, no big surprise, you got ExxonMobil on the far right, and a little bit surprising, J&J.
I would agree. So again, want to thank you all for your time. This is not the easiest time. So we made a lot of moves because of the risk that's out there. And we hope that you're managing risk as best as you can. And who knows, this is a funny market where it could have more of a capitulation to the downside. You could get something over the weekend where war's off and you get that snap that's possible as well. So we follow the trends, we follow big money, we follow risk management rules. I know it's not easy, but in these environments where the stress is a little bit higher, I'd always encourage everyone just to get out there, get in the sun, get away from the screens as much as you can on the weekends, try to get a workout in, treat yourself with good, healthy foods. But this is an environment where we just don't want it to eat you up. We want you to live your best life, and hopefully your money is protected and growing is the entire mission of why we're doing what we're doing. We care about you. Again, I'll end there. Enjoy your weekend. Thank you for all your time. Look forward to connecting on the next week's call, and we'll catch up soon. Thanks so much. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.